February marks the start of another reporting season, with over 150 companies on Shareclarity reporting their half and full year results. Ordinarily, we'd pay close attention to the retail businesses who have just come through their busiest Christmas trading periods, looking to see who performed well, who bought well, and who managed to clear their inventories. And we'd pay less attention to the power companies as they build up to their busiest summer milking and winter heating months. But this year things seem a little different, with the world facing many unknowns. Europe is still trying to effect Brexit, 15 major nations will soon hold their general elections, and Donald Trump is only a few weeks into his presidency. From a fundamental perspective, one could argue that the market risk premium has increased because of the potential for rapid and unexpected economic change, especially for the United States labor and capital markets. Anything seems possible, including higher foreign taxes, greater import restrictions, and new labor laws favoring domestic employment, and each has the potential to change foreign currencies, interest rates, and trade relationships. So as an investor, I would want to know how much of my portfolio is directly and indirectly exposed to these macroeconomic risks. The impact of Donald Trump's presidency won't show in these half-year numbers, so it's important to keep an eye on any outlook statements and to stay on top of any early indicator companies that report monthly operating statistics, like Qantas, Cathay Pacific Airways, and Air New Zealand, zeroing in on their international passenger numbers, ticket pricing, and route changes. Also keep an eye on Sydney Airport and Auckland International Airport's international passenger numbers. Any noticeable drop in passenger numbers could signal the start of traveller weariness, which could have negative flow-on effects through the travel agencies like Flight Centre, Webjet, and Hello World, and the domestic tourism operators like Apollo Leisure and Tourism Holdings, whose EBITDA multiples are more than double what they were 5 years ago. I'd also keep a track on any companies that release quarterly accounts, especially multinational logistics companies like Mainfreight, whose earnings can serve as an early indicator to general trade and domestic production. Similarly, any noticeable drop in real revenue or margins could signal the start of retail and manufacturing slowdowns. Any companies with above average working capital, like Schaefer, Gale Pacific, and ARB, may face added share price pressure if this were to play out. And finally, I'd keep an eye on the business papers to see if the United States private equity firms start to resell their investments and whether the Chinese corporates stop making strategic investments in Australia and New Zealand manufacturers. If this happens, one could see lower acquisition premiums, particularly those already built into the companies with large cornerstone shareholders like Airwork, Budrum, and TNG Global. So in summary, there will be surprises over the next 3 weeks, and the market will be particularly harsh on any underperformance, but the outlook from here will almost certainly be more important. If the market starts to slow or destabilize, don't be surprised to see investors favor non-discretionary domestic companies like G8 Education, Chorus, and Contact Energy.